There is a $35 charge sitting inside your bank account right now. You do not know it is there yet. It will arrive the moment your balance touches zero. Not when you ask for a loan. Not when you make a bad investment. The moment your account hits zero. $35. Automatically. From a system that knew your balance before you did. This is not an accident. This is a business model. And before this video is over, you are going to understand exactly how that business model works, who it targets, how much money it generates, and why the people running it are not breaking any laws. Because the most uncomfortable truth about how banks make money off poor people is not that they are corrupt. It is that the entire system is completely legal, completely deliberate, and hiding in plain sight inside the terms and conditions that almost nobody reads. Let us start with the number that most people never hear. In 2022, banks and credit unions with over $1 billion in assets collected $7.7 billion in overdraft and insufficient funds fees in a single year. $7.7 billion. Not from wealthy clients, not from corporate accounts, from people whose balances went negative, often by less than $50, often for less than 72 hours. By 2024, that number had shifted to approximately $5 billion, partly because some banks had voluntarily reduced their fees under public and regulatory pressure. JP Morgan Chase led all banks in overdraft revenue that year, collecting over $1 billion. Wells Fargo collected another $1 billion. Two banks, $2 billion from overdraft fees alone. Here's how overdraft works in practice. Your account has $43 in it. You forget about a gym membership that auto-renews for $47. The charge processes overnight. Your account goes negative by $4. The bank covers the $4, then it charges you $35 for covering it. You now owe $39 on a $4 shortfall. If two more small charges process before you notice, each one triggers another $35 fee. You can owe over $100 in fees on a deficit that started at $4. The Consumer Financial Protection Bureau found that 79% of all overdraft fees were levied against just 9% of account holders, the same people over and over. The banks call them heavy overdrafters. What that phrase actually describes is people who are consistently living close to zero, people for whom a 2-day paycheck delay or an unexpected bill is enough to send the account negative. People who cannot afford the fee that arrives when they cannot afford to avoid it. The math of this is almost elegant in how precisely it works against the person who has the least. If you have money, the fee does not reach you because you have money, because your account does not go negative. The fee is structurally designed to only activate at the moment when activating it does the most damage. And it activates automatic. No human being decides to charge you. The system decides based on one variable. Your balance is negative, but overdraft fees are only the beginning. They are the most visible mechanism. There are several more operating underneath them that most people never see because they are built into the architecture of how banking works for people without money. Mechanism 2, the minimum balance fee. Most basic checking and savings accounts at major banks charge a monthly maintenance fee if your average daily balance falls below a certain threshold. That threshold is typically between $500 and $1,500 depending on the institution. The fee is typically between $12 and $15 per month. This means that if you cannot maintain $1,500 sitting untouched in your account, you pay the bank for the privilege of the account that is supposed to be holding your money, $144 to $180 per year, not for anything you bought, not for a service you chose, for failing to have enough money to qualify for the free version of the account. If you have $1,500, the fee disappears. The system charges the people who cannot afford it and exempts the people who can. That is not an accident of design. That is the design. Mechanism 3, the interest rate gap. When you deposit money in a basic savings account at a major bank, the bank pays you interest. At most large institutions, the rate on a basic savings account is around 0.01% annually. That is not a typo. 0.01%. On $10,000, that is $1 per year. Simultaneously, the bank takes your deposit and lends it out. Mortgages at 6 to 7%. Auto loans at 8 to 12%. Credit cards at 22 to 29%. Personal loans at 10 to 24%. The bank is borrowing money from you at effectively zero and lending it out at anywhere from 6 to 29%. The difference between what they pay you and what they earn is called the net interest margin. It is how banking has worked for centuries, but the spread is not uniform across customers. The less money you have, the wider the gap between what you earn on your deposits and what you pay on your borrowing. The system consistently extracts more from the people who have less. Mechanism 4, the credit card trap. When you have no credit history and low income, the credit cards available to you carry interest rates between 22 and 29%, sometimes higher. If you carry a balance, you are paying that rate on every dollar you owe. A $1,000 balance at 26% generates $260 in annual interest. That $260 is pure revenue for the bank. It required no product, no service, no labor. It required you to owe money for long enough for the interest to compound. The people who carry credit card balances are disproportionately people who are using the card to cover shortfalls, not vacations, groceries, utility bills, car repairs, the kind of spending that happens when your income does not quite reach your expenses. And the credit card is the bridge. They are paying 26% annually for a bridge that is keeping them in place, not moving them forward. And the bank is collecting 26% on the money they needed to survive the month. Mechanism 5, the payday loan ecosystem. This one operates at the edges of traditional banking, but major banks are connected to it more directly than most people realize. Payday loans charge average annual percentage rates of 391%. That is the average. Some go above 600%. A person borrows $300 to cover rent before their paycheck arrives. They owe $345 2 weeks later. If they cannot pay the full amount, they roll the loan over. Another fee, another 2 weeks, another fee. The Consumer Financial Protection Bureau found that 80% of payday loans are renewed multiple times. Only 1% of payday loans go to borrowers who take a single loan, repay it in 2 weeks, and never return. The other 99% become repeat customers, not by choice, by math. Here is the connection to major banks. Researchers at the Public Accountability Initiative found that major banks, including Wells Fargo, JP Morgan Chase, and U.S. Bancorp, provided over $2.5 billion. The banks that charge $35 overdraft fees to people who go negative by $4 are also providing the capital that keeps the payday lending industry running. The system is connected. The people without access to the front door of banking end up at the back door of payday lending, and the same institutions profit from both doors. Now, here's the part of this that most people miss when they get angry about these mechanisms. The banks are not doing anything illegal. Every fee is disclosed in the account agreement. Every interest rate is stated on the card. The overdraft fee is listed in the terms. The minimum balance requirement is in the documents you signed when you opened the account. The law requires disclosure. It does not require clarity. It does not require the bank to tell you in plain language that if your balance goes negative, $35 will be automatically removed. It requires the information to be present somewhere in a document that the average person does not read and would not fully understand if they did. The system is not broken. The system is working exactly as it was designed. The design just was not made with your interests as the primary consideration. The Consumer Financial Protection Bureau, created after the 2008 financial crisis, specifically to protect consumers from exactly these mechanisms, attempted to cap overdraft fees at $5. That cap would have saved the people who currently pay $35 per occurrence, approximately $30 each time their account went negative. The rule was repealed in 2025. The $35 fee came back. Now, here's what this actually costs at the level of a lifetime. A person who is chronically overdrafting at the low end of the spectrum, paying 3 to 4 overdraft fees per month, is paying over $1,000 per year in overdraft fees alone, on top of monthly maintenance fees, on top of credit card interest on a balance they are carrying because the overdraft fees themselves pushed them further negative. The fees generate the conditions that generate more fees. The debt generates the conditions that make the debt harder to escape. 12 million Americans take out payday loans each year. The average payday loan borrower takes out 8 loans per year, not 8 individual borrowers, each taking 1 loan. The same borrowers returning 8 times because the loan did not solve the problem. It delayed the problem and added fees. The use of payday loans doubles the rate of personal bankruptcy. 1 in 5 car title loan borrowers, a variation on the same mechanism, have their vehicle seized. These are not edge cases. These are the documented outcomes of a system operating at scale on the people who have the least ability to absorb the cost of its operation. What does the other side look like? If you have $1,500 in your account, the monthly fee disappears. If you have a credit card you pay off every month, the 26% interest rate is irrelevant because you never carry a balance. If you have a strong credit history, the rate you are offered on a mortgage is 6% instead of 8%. The rate you are offered on a car loan is 5% instead of 11%. Over the life of a 30-year mortgage, the difference between a good rate and a bad rate can be $50,000. Not because the house cost more, because borrowing the same money cost more for the person the system assessed as higher risk. The same amount of money, the same asset, a different price based on a profile that was largely shaped by whether you had money to begin with. This is what the phrase poverty tax actually means, not a tax you choose to pay, a tax the system levies automatically against the condition of having too little. The less you have, the more it costs you to have it. The more it costs you to have it, the less you accumulate. The less you accumulate, the longer you remain in the tier where the fees apply. Here is the exit. It is not dramatic. It is not a secret the banks are hiding from you. It is structural and it takes time, and it starts with understanding the fee triggers before they activate. Overdraft fees stop when your balance does not touch zero. The first offense is knowing your actual balance at all times, not the posted balance, the available balance, accounting for pending charges. Many banks now offer low balance alerts that notify you before you go negative. Turning that alert on is free. It does not eliminate the mechanism, but it gives you the information you need to avoid it. The minimum balance fee disappears when your average daily balance meets the threshold, or when you set up direct deposit, which most banks accept as an alternative qualifier. If neither is possible, credit unions typically offer free checking accounts with no minimum balance requirement and no monthly fees. They are not for-profit institutions. The incentive structure is different. The credit card interest rate is irrelevant if you pay the full balance every month. Using a credit card like a debit card, spending only what you already have and paying the full balance on the due date gives you the benefits of credit card usage, the credit history, the consumer protections, the potential rewards, without ever paying a dollar in interest. The rate only applies to balances you carry. The payday loan is the most urgent exit because it is the most expensive entrance. A payday loan at 391% annual interest is never the cheapest option available, even when it feels like the only option. Credit unions offer small emergency loans. Many employers offer payroll advances. Some nonprofits offer emergency bridge funding. None of these options are widely advertised because none of them generate 391% returns. You have to find them, but they exist. Here's the sentence that ties all of this together. The banking system does not charge poor people more because poor people are more expensive to serve. It charges poor people more because poor people have less leverage to push back, less information to navigate around the fees, and less ability to absorb the cost of staying in the system. The fees are not priced according to cost. They are priced according to what the customer cannot avoid paying. Understanding this does not immediately change your balance, but it changes what you do do with the information you now have. The fee that was invisible before is now visible. The trigger that was automatic is now something you can see coming. The mechanism that was designed to be opaque is now, for you, transparent. And the first thing that changes when you can see a system clearly is that the system loses its automatic claim on what you have left. That is not